time for Technical Tuesday. Kevin Horner, Senior Manager, Trading Services Education here for Charles Schwab. And I'll tell you, there's one trader, we call him Einstein of Wall Street, Peter Tuchman. He has the S&P 500 7,000 hats. He showed them to me, but you're not allowed to take them out of the box or wear them until you actually close above that level. But boy, we're getting closer and closer because we're at 6,900 today. Tell me about some of the levels that you're watching.
We sure are, Nicole. You're absolutely right. Great to see you as always. Continue to push. I mean, what are we going to say? We break a 20-day moving average. We find support at the 50-day instead, and we just keep pushing. I think the takeaway remains monitoring the trend, working with levels with which you have comfort as traders, and staying with it. We've been above the 50-day moving average here in the SPX dating back to May 1, with one significant test really coming on the heels of the president's commentary around China and trade. And that happened just 2 weeks ago. And since then, we're back to new all-time highs. So what are you going to say other than monitor the trend? And I'll give you two percentages to keep aware of. Number one, the 50-day is about 4.5% away from where we are right now. That means if traders are going to stay long, they basically need to be comfortable with 4.5% to 5% pullbacks in managing their trades to be proven wrong about the trend holding. So if that 50-day doesn't maintain, then maybe we see the 200-day at 6,100 or so. That's about a 13% move, though, Nicole. So there's plenty of reason for traders to look to lighten up should we break the 50-day moving average. It may be a while before we see it, but you always got to be prepared for things that we don't necessarily think can occur.
Yeah, and look, and that's not necessarily a small move to be comfortable with 4 or 5%. It's not a small move. Let's talk about Broadcom, because Broadcom obviously has been running up, not too far off the highs. Some of your thoughts here.
Yeah, basically trying to pop to new all-time levels here today. The interesting thing, I think, is the action we've seen since their most recent earnings in early September here. We basically gapped up and created a brand new range on the stock, trading between essentially 325 and 370, giving about a 45-point range, and it's dabbling with a breakout as we speak. So the nice thing is that after it made that new high following earnings, which were well received, we had a throwback to the 50-day to test support and maintain that 325 zone. So, if you're a trader looking at this range and trying to calculate upside opportunity, one way to look would be to take the height of the range we are possibly breaking here today, 45 points, and add that to the 370 level that was prior all-time high. So potentially targeting about 415. Of course, measured moves are never a guarantee to be achieved, but that's what bulls are looking for if this can close at new all-time highs here today, perhaps.
Yeah, look, it's looking like it could have a record high close. We'll have to wait and see. And then there's PepsiCo. We've heard from the company. Some of your thoughts on the moves.
Well, this one's interesting over two time frames, so I want to make sure we talk about that. Number one, you've had Pepsi respond favorably following its earnings here, and it popped to the upside and is building on the daily chart what looks to be about a bull flag. But I've got some other levels drawn in that are going to be very important. That 158 level above stands out. Even on this daily chart, you can see that we had run to it in February, March of this year, had pulled back. We had the peak there in mid-August, and we've pulled back from that to test the 138 level. But even if you're bullish here, because we are above the 20, the 50, and 200-day moving averages, you may want to temper enthusiasm. And I think if we shift to the weekly chart, I think this will illustrate exactly why. The weekly look here highlights a head and shoulder breakdown in Pepsi, and that breakdown occurred through the 158 level. That was the neckline. That was confirming the break, and then we slipped all the way down 30 more points to 128. So now what once was support for us at 158 can now act as resistance for us now. So we've rallied back into that approximate area, and I think it would bode favorably, of course. It would more or less give bulls a new uptrend if we can get back above 158, but that's a very significant level. So even daily traders looking at the optimism you've seen over the last couple of weeks here following that earnings report, you just got to be aware of the importance of 158. Moves into that could be an area for a pause in any recent strength.
All right, Kevin Horner, great to see you. Senior Manager, Trading Services Education at Charles Schwab.